Thank you for tuning in to episode 260 of This Week in Real Estate. The T-Wire podcast broadcast live Wednesday, January 17th, 2024. Is the winter housing market on fire? This episode was brought to you by listeners and viewers just like you. Thank you guys so much for supporting the show. Because of your support, now we are actually a YouTube partner. So that's kind of cool. But please take just a second and send this show to someone who's just like you. Because after all, it is viewers and listeners like you that make it even possible. And of course, if you're watching on YouTube, you can comment and then we can display your comment and we can talk about you, or we can talk about your comment. And now, because we're a YouTube partner, if you wanted to, you can actually make your comment a super chat and it'll stay at the top for a little while longer. Olivier, he's joining us on YouTube. He says, I'm ready to rumble. We're also broadcasting on Facebook and LinkedIn, so shout out to those of you who are joining us there, and hey to the replay crew. Hey to everyone that's downloading the podcast and listening to it traditionally. I love hearing from you guys, especially, so please reach out to me on Instagram. Let me know you listen to the show. And if you're on Clubhouse, you can join our Clubhouse room, and then you can actually participate and add your voice to the podcast. And it will be broadcast for everyone else to hear in perpetuity. Elizabeth Nightingale says, hello, fellow rumblers. Hi. Well, thank you guys for joining us. We're going to pretty much dive right into the show now, too, because we don't have as much industry tea as we normally have been with all the lawsuits and the realtor lawsuits. I feel like for the last 4 months, it's just been nothing but like industry tea stories to start off the show. But we still have two that I thought were pretty interesting. The first one is this lawsuit by Zillow and ShowingTime versus two different MLS services. So this was reported on Housing Wire and actually brought to us by Dusty, who is a Be More contributor. She's in the contributor chat. If you guys want to join the contributor chat, let me know and I can add you to our little, it's a Facebook message. So you have to have Facebook. But I can add you to the Facebook messaging group where we all kind of talk and chat about these news stories. But basically, Zillow Group and ShowingTime are taking two multiple listing services to court due to their allegedly anti-competitive behavior. On Friday, Zillow Group and ShowingTime filed a lawsuit in U.S. District Court of Arizona against Arizona Regional MLS and Wisconsin-based Metro MLS. The lawsuit also names the MLS Aligned, the parent company of the showing platform Aligned Showings. So Zillow Group buys ShowingTime in 2021. The complaint alleges that the defendants unlawfully attempted to monopolize the market for real estate showing management service in geographic regions they control, and from unlawfully conspiring to exclude or severely limit ShowingTime, their competitor in these markets. So Zillow Group and ShowingTime said they filed a lawsuit in an effort to restore the playing field, to be given an opportunity to fairly compete. So the interesting part about this is the agents there, whenever Zillow bought ShowingTime, they said, hey, protect our clients' data. We don't want this. The MLS creates its own showing service. I'm giving you the Ray phrase, by the way. This is the MLS creates their own showing service, allows their own showing service to have access to the MLS, encourage agents to switch. Some agents switch. Then, and I think this is the anti-competitive part that Zillow doesn't like, they let ShowingTime know that they were going to cut their access by February of 2024. So, according to the complaint, the Aligned Showings platform was initially launched alongside ShowingTime, but the defendants allegedly, quote, conspired to use various tactics to steer their members to Aligned Showings, including by making Aligned Showings the default showing service, positioning Aligned as a means of moving away from a competing product. So this is similar. The behavior of the MLS is probably right with a lawsuit. The reasons the MLS is doing it is probably just. But the way they're doing it is what is causing them to get into big trouble, I think. If you remember, Microsoft, this is the classic case. Microsoft got in trouble for making their web browser the default web browser on all the computers. And it was basically stifling competition from Google Chrome, Firefox, was Netscape Navigator. Y'all remember those days? So if you remember, the reason why they got into so much trouble is because their web browser was set as the default on all the computers, and they made it more difficult for competition to get an inroads. And it was a classic case, similar to what is happening with Aligned. So you'd have to wonder how the attorneys that work for the MLS did not advise on how to do this. That's definitely not the way to do it. Zillow says, or the complaint says, by making Aligned Showings the only integrated option in the MLS member portal, the MLS defendants are substantially foreclosing ShowingTime from their markets and giving Aligned Showings a monopoly over the showing management platforms in their respective regions. If defendants are allowed to continue with their anti-competitive scheme, ShowingTime will be foreclosed from these regions. Zillow and ShowingTime is seeking injunctive relief, putting an end to the defendant's alleged anti-competitive behavior. Well, the good news is they're not, I think the good news for the MLS in this case is that they're not asking for a whole ton of money, because I think if they were asking for a whole ton of money, they may get it. It seems pretty cut and dry. You can't do that. So, but we'll see. We'll see what the court says. Maybe I'm totally wrong. I could be completely wrong. But this is just another lawsuit that an MLS board has to deal with, given all of the various lawsuits that are kind of out there right now. So we'll keep our eye on that. Dusty, our resident AZ agent, is going to keep us informed of it. And she is the one that said, the reason why they want to do this is to protect their clients' data. But then in reading the complaint, how they're going about it is going to be suspect, I think. Olivier said, are we talking about a privately owned business choosing a supplier? Okay, MLS is more like a co-op. But it's not the government. It is not the government. However, even a privately owned business can't create a monopoly that forces other companies out of the market using anti-competitive behavior. So that is a tried and true. I don't know it's not Sherman antitrust. That's not the thing. Or maybe it is. But anyway, it's the monopoly clauses and laws. They don't allow it. Just the board game. Okay, next up, we've been keeping tabs on brokerage announcements and kind of what they're doing. But this is really kind of the first big one of the new year, and it was brought to us by Broke Agent Media. It happens to also be the brokerage that I am affiliated with, so I'll put that out there as the disclaimer. But Real Broker announces 2 new programs for teams and brokerages: the private label program and the Pro Teams program. So I think the most interesting part about this, and kind of the reason why it makes it newsworthy, is this private label program. A lot of people are familiar with Side and how they will basically come alongside of a team or a brokerage and give the team or brokerage all the tools and resources they need, while also allowing that team or brokerage to market themselves as themselves. And I know on contracts, because I have a friend that switched from a brokerage that was at Slide to Real. And I know in the contracts, it has like this team at this brokerage partnered with Slide. So on the actual contracts, it gets quite long. But the private label program is there to help people who already have, a great name in their market. They don't want to have to go through the rebrand process. And so the private label allows them to do that. Ideal for like large brokerages that are making a switch and that kind of thing. So Sharon Srivatsa says the Real platform, we're focused on providing agents and team leaders the best platform which to service clients' long-term wealth. Today's market, independent brokerage owners and team leaders need a platform that gives them the ability to scale. Our private label and Pro Teams, which I'll get to the Pro Teams in just a second, give owners and team leaders the power to overlay the Real model and all the benefits associated with being part of the fastest growing publicly traded firm. Kofi, he's one of them, the leader of Global Red. The other thing they announced that I thought was interesting was Pro Teams. Real's new Pro Teams program allows leaders to continue to to continue using compensation model that works best for them and to fully customize financial packages, including caps, splits, and fee payments down to the individual team member level while reaping the benefits to go with being part of the Real ecosystem. So I feel like what they did here was use the system that Real was using to manage splits and all that kind of stuff that's happening. And basically everyone at Real is kind of on the same split with the brokerage, but still it's a great back-end platform that allows them to manage those splits to us. They're basically giving that technology now to pro teams, brokerages that come over, that kind of thing, so that they can now use that same technology to manage how everything is split down the road. So kind of cool, but not as, I think the biggest news is private label. And I have mixed feelings about it because a private label program like Slide, it's cool, but you don't see Slide out there in the marketplace very much. And so the actual growth of Slide is dependent on basically word of mouth, which that's not bad. You just don't get the free marketing from a Slide agent having, 300 listings in a marketplace, right? They have 300 listings in a year. You don't see slide now all over the place. You see their label, which that's fine, but it doesn't really do much for the marketing of the brokerage. But I think it'll be a really useful tool, especially for companies, brokerages, big teams that want to maintain their brand and make a switch to get the help. So interesting. Those are really the only two things in our industry T category this week. There wasn't a whole lot of industry news for the first time in a long time. Christina Smallhorn, what's up? She says, happy Wednesday. Super chatted. Thank you very much. Oh, wow. Olivier, I've never received Canadian dollars. He gives me 2 CAD. I don't know what that is. That's I think 30,000 American. So I appreciate that. Oh, he said now you can buy yourself beard ornaments. Oh, it's worthless. So it's the other way. So well, thank you guys for that. Christina, towards the end of the show, we're going to be talking about the best markets for first-time home buyers based on affordability. So you're here early. I did mention affordability in the pre-show to Clubhouse folks, but we're going to be talking about some affordable markets and kind of what's going on. And speaking of which, Homeownership by Gen Xers, it's not great. It stagnated in 2023. But here's the interesting part. You would think that kind of home ownership across the board seemed to stagnate because as rates went up, there were fewer people interested in buying a home, but it didn't. If you look across the board, you see that the home ownership rates for Millennials and Gen Xers actually gained. So let me share this chart here. There we are. Okay. So this article is on Redfin. Here's the chart that I want to show you guys towards the bottom. I can never get that chart quite lined up right because the margins on these Redfin articles are just really smashed right up against it. There it is. All right, now you see it. All right, so roughly 1 in 4 adult Gen Zers are homeowners, so only 26.3%, while millennials are sitting at 54.8%, Gen X is at 72.0%, and baby boomers are still at 78.8% of homeownership. So definitely, as you get older and more people are buying. Now, if you recall, millennials were some of the latest to purchase. And you could see the Gen X, how they kind of had a steady up. The millennial almost had, it's not like a downturn, but it's like is that a convex? Somebody tell me in the chat. It's like convex. I think it may be convex. There's a little convex curve. I'm trying to explain it for audio listeners as it continues to go up. So, I don't know, is it concave? Maybe concave. Anyway. So Christina Smallhorn says Gen Z ownership for them is out of their pay scale. That starts to make sense as the average first-time home buyer goes up every year. You have to be 30 to buy a home now. Yeah, They're also later to marry, later to settle down. So, Paul Peters says this dude looks like Sasquatch is making love to his face. Thank you, man. I appreciate that. Wow. So cool. All right. So as we continue to go down this Redfin article, the good news is that 2024 is shaping up to be a more affordable year for homebuyer than 2023. Mortgage rates have dropped from over 8% in October to 6.8% of mid-January, pushing homebuyers' monthly payments down more than $300 from their 2022 record high. So the drop in rates is bringing both buyers and sellers to the sidelines, off of the sidelines. It's an increase in sellers has fueled the jump in new listings, which gives buyers more options to choose from, could ultimately put downward pressure on prices. Downward pressure on prices means that we will see the articles that say home price gains slow. It's still going to be a seller's market for a while. Home prices are not going to go down. But we should see home price gains slow. That should be the title of articles that we... Daryl Fairweather, Redfin's chief economist, she says that housing affordability remains strained, but things are looking up for Gen Z. Recent decline in rents means Gen Zers could put more money to savings for down payment. Most adult Gen Zers are tracking ahead of where their parents were at the same age. That's interesting. So it's looking up for Gen Z in 2024. Are you guys seeing more inventory? That article mentions that more inventory is coming on the market. Are you guys seeing more inventory hitting the market? Because there is something that we've been talking a lot about called the lock-in effect. So are sellers locked into their home and locked out of the market? Or are they all about to flood to the market this spring? 89% of people with mortgages have an interest rate below 6%, which is down from a record 93% in 2022. So it's still better than 2022, but it's still really high. Elizabeth Nightingale says, not really increased inventory in Charleston, South Carolina. 50% of sales are new construction. Whoa. Now, nationwide, maybe a month ago, we saw that about 30% of sales were new construction when the normality, I believe, was around 15%. So that's a huge amount of new construction, Elizabeth. Olivier says, more in mind for sure, but I'm up north. We're still below historical supply on the market. Elizabeth says, and I am sure those are super duper quality construction. What? Are you saying there's corners being cut? Christina says the reason why they're delaying purchasing the homes, the Gen Zers, is because they don't have the money for marriage, children, and homes. Pay sucks for them. Affordability, income is a big issue. But I guess there's so many workers in the marketplace that everyone can kind of get away with paying what they need to pay and still have full employment in their company. Okay, so let's talk about this article, the lock-in effect. 89% of people with mortgages have an interest rate below 6%. That's down from a record 93% in 2022. Nationwide, 88.5% of homeowners. That means that more than 88.5% of homeowners with mortgages below that rate have a weekly average of 6.66. Devil number. Prompting many to stay put instead of buying. Interesting graph. I like this graph a lot. Let's see if I can open this in all right, here's the graph. Ooh, yeah, that's a much better display. Nearly 9 in 10 U.S. home mortgage holders have a rate below 6%. Okay, so this green at the bottom is the below 3% rate. And you could see in halfway through 2020, that number really starts to go up. And it goes up to right under 25%. And that number did start to kind of fluctuate. Oh, I'm not sharing it. I'm sorry. I am sorry. Okay, here. Now I'm sharing it. So as I was saying, in 2020, halfway through 2022, that number really starts to go up. Yeah. And then it starts to fluctuate down just a little bit, but still this turquoise blue, which is stacked on top of the green, is the rate of 3 to 4%. And then that continues to go up. And so it all kind of continues to go up to this very, very top, says above 6%. And that number, look in 2013, how many people had a rate above 6%, was right at, what is that, 30, around 30% of people in 2013 had a rate above 6%. And currently it's super low, right around 20%. Right around 11%. From 5 to 6% is right around 20%. So the theory is, with all these people sitting at home and the monthly payment super cheap, why in the world would someone list their house right now? It's only the people that have to move that are selling. And a couple of months ago, you would say it's only people that have to buy are buying because the rates are high. However, the rates are starting to fluctuate downward. And so that is big news for home buyers that are looking to make a purchase. But here's a weird stat on all these housing stats that we've been looking at. Millennials with kids own half as many large homes as empty nesters. Millennials with kids own half as many large homes as empty nesters. This report's also on Redfin. Empty nest baby boomers own 28% of the nation's large homes, while millennials with kids own just 14%. So why is this? Is this a money issue or is this a lifestyle issue? Empty nest baby boomers own nearly 3 in 10. That's 28.2% large homes. That's twice as many millennials with kids. An additional 7.5% of the country's large homes are owned by baby boomers with households of 3 adults or more. This category likely consists of adult children living with their baby boomer parents. And as baby boomers get older, I think you're going to see more of that as well. Dusty, what's up, Dusty? We talked about your market earlier. She said, I've had 2 sellers in a row sell their home they bought at a low rate just to purchase something else in a lower price point so they can retire with no mortgage. Taking the gains, putting in something smaller, retire with a paid off home. Elizabeth says in California, you might be grandfathered into Prop 13 taxes if you're a boomer. It is such a great deal, and that is causing them to stay put. Even more reason not to move in Cali. Maybe they're just trying to keep them all from going to Texas. So it's worth noting that even though millennials with kids own half as many large homes as empty nesters, there are more millennials than baby boomers. Millennials make up roughly 28% of the country's adult population. It's the largest share of any generation. They are followed by baby boomers, which is 27%, Gen Xers at 25%, and Gen Zers at 12%. It just goes to show you how long we've been doing this show. Because when we started the show, baby boomers were number 1. And now millennials have surpassed them. Baby boomers own an outsized share of large homes for several reasons. One, there's not much financial incentive to move. For millennials and Gen Zers, it's harder to afford a home. And this is the interesting stat. Redfin found that 12% of millennials believe they'll never own a home or just aren't interested in home ownership. 7% say they don't plan to buy because they don't want to maintain a home. And then last two, boomers are older, so they have more time to buy homes, and boomers built wealth. They built wealth in the 1990s economic boom and were able to afford bigger homes. I think you are seeing a big change in how people live, though. A lot of millennials I know, they love to travel. They don't want just a big home to be paying for a big home. They would rather have a slightly smaller home and a lot of experiences. And I think that kind of bears out in the numbers. All right. The new year brings an uptick in early stage demand. So this is the question. Early winter is showing signs of a hot housing market. Is it sustainable? So drop it in the chat if it's sustainable in your area. What would you need to see? Another hot housing market. Some are saying, few are saying, but some are saying, a 2022, 2021 feel of a hot market where both buyers and sellers are entering into the market in the late winter, early spring. And they're saying they're seeing this from the purchase demand and the activity right now. Redfin agent reports as the new year kicks off, more sellers are listing and more buyers are going on tours and applying for mortgages. Mortgage purchase applications are up 3% from a month ago. What's the date on this article? This is January 11th. I've got an updated number for that too. Redfin's Homeowner Demand Index is a seasonally adjusted measure of request for tours and other buying services from Redfin's agents is up 5% from a month ago. Pending U.S. home sales posted their smallest year-over-year decline in 2 years at negative 3%. And there are 9% more listings than there were a year ago, while the total number of listings is down 3% annually. There are 9% more new listings than there were a year ago, while the total number of listings, I guess that includes the resale homes as well. Maybe it's saying new as in new construction, because that doesn't make sense. More buyers are out there touring. With the activity up, I think prices will rise and bidding wars will become more common. What? Dusty says, yeah, that sounds about right. I'm super busy with buyers right now and houses are flying off the market. Inventory is down, at least if it's under 1 million. So inventory in the bottom 2/3 of the market is flying. The leading indicators they're looking at is the daily average fixed rate. That's up just slightly from 6.72% to 6.78%. So it's up from over the year, 6.14% last year. So hasn't changed that much. Weekly average 30-year fixed hasn't changed that much. Mortgage purchase applications. Now this is the part I don't get. Because those that are predicting like a super hot housing market in the winter, it's down. Mortgage purchase applications are down 16% from the previous year. Their own homebuyer index is down 9%. Their Google searches for homes for sale is down 20%. So how can you look at those numbers and be predicting a hot housing market coming up in the winter, early spring? Elizabeth Nightingale said, along the southeast coast, we need to see more competitive insurance rates to keep the housing market hot. The coastal insurance rate has increased significantly, causing unaffordability just based on the insurance premiums. Are homeowners that are there, are they seeing insurance increases, or are they grandfathered in to what they currently have? How's that working? I feel like we kind of warned about this last year when we were saying that they were going to use new climate change data. And all the climate change, it's like, well, the whole world's going to flood and we're all going to die. Well, okay, if you're basing your insurance on that data, yeah, insurance is going to go up. I don't think they're using the historic figures like they used to use. Dusty says, I don't know, those are our busiest season here. It's not a huge gamble to claim that. Ooh, she said Elizabeth said existing homeowners are getting hit with an increased rate Ask me how I know. That happened to you. Olivier said, I'm pretty sure people are just hoping for rate cuts, which I thought were coming soon, but I'm wondering if rates will actually be the same at the end of the year. He said, so I think it might be 12 to 18 months out of a market shift, but longer term will be looked like a good idea to buy now. Yeah, I feel like the home prices are still going to go up. So if you did buy now, you're going to have advantage that interest or that home price increase. Whereas if you waited, the rate may go down a little bit, but is it going to go down that much? Probably not comparative to the home price increases. All right, let me double check this chart, see if there's anything else on here. The median sales price declined in 5 metros, but pending sales increased in 14 metros, and new listings declined in 10 metros. All right, so those are the numbers from Redfin. Mortgage demand surged. So buyers do seem to be running to the market after the holidays. Mortgage demand surges more than 10% as lower interest rates lure home buyers. So this one's the one up to date. This article just came out today. Another drop in interest rates caused a run on loans last week. You want to be careful when you're writing an article and you say a run on, and you're then talking about banking. A run on loans, not a run on homes, and definitely not a run on the banks. Total mortgage application volume jumped 10.4% compared with the previous week, according to the Mortgage Bankers Association seasonally adjusted index. The average contract rate decreased to 6.75% from 6.81%. Mortgage rates declined across all loan types as Treasury yields moved lower last week on incoming inflation data, which helped support the rise in mortgage applications, said Joel Kahn. He's the vice president, deputy chief economist at the Mortgage Bankers Association. Applications for mortgage to purchase a home rose 9% for the week, but were 20% lower than the same week 1 year ago. So applications to purchase rose 9%, but were 20% lower than 2023. Now, if you remember the market in 2023, we had 6 months of incredible. And then in most big markets, they had 6 months of like disaster as far as real estate business goes. They weren't doing anything for 6 months. But the first 6 months were incredible. I had many people saying that they made as much in the first 6 months as they had in the previous year. And in the last 6 months, it was nothing. I'm wondering if this may be similar. Instead of a 2022 market, what if we were to see another 2023 market? In order for that to happen, you would have to have a decrease in inventory and an increase in interest rates in the fall. If it stays like it is now, then you might have a better year than 2023. But I don't think it's going to be the year that 2021 was as far as the number of homes sold. Because we're still 20% lower than the same week a year ago. So maybe it's a more balanced year. Maybe that's what we're looking for. Olivier said agent numbers are down 25% here, but looking at social media, they are all millionaires. What? The influencer effect. Elizabeth Nightingale said, people that move to Florida are having trouble getting home insurance, and they're coming back up to the East Coast. We call them halfbacks. Oh. That's funny. Dusty said her prediction will be good, but not crazy good. Yeah, I mean, if they're predicting a hot housing market, but then they're saying it's not as hot as 2023, but you remember what happened in 2023 was super hot at the beginning of the year and kind of slowed down towards the end of the year, then maybe it's just going to be a more balanced year, which is not necessarily a bad thing. Nikita Bell, who was renting in Detroit, they bought a home, or they were at an open house. And this may be the mindset of a lot of home buyers out there. So she's at an open house thinking about buying a $254,500 home. And she says, I know I'm never going to get 4%, but what I don't want is 9, 10, 11, and 12%. It's not a credit card, it's a house. So it could be the fear of future increases in interest rates that is driving some people to the market, despite the fact that they can't get back down to 2.5%, 4%. They're still only about 2% off from 4%. So that doesn't sound that bad. But compared to the 8% that it was, we're 2% down from that. So we're kind of in the middle right now. So lower rates are also giving some current homeowners an opportunity to save money. Applications to refinance a home loan increased 11% compared with the previous week, and were 10% higher than the same week a year ago.
Hey, Ray.
Yeah. What's up, Mike?
So what I'm experiencing with some buyers is they're waiting for the rates to continue to drop. So they're not taking advantage of the reductions we've had. And I think part of that is because the media, everybody talks about how, the Fed's expected to drop rates in March. And also, I don't think they are going to drop like everybody thinks. Like the Fed presidents that have been speaking are kind of walking back those expectations.
Yeah.
So I don't think we're going to see the drop until something breaks in the economy, or it looks like, the recession warning is flashing brighter. So I don't think rates are going to get much better anytime soon until something bad happens.
Yeah, I mean it is an election year, so we might see anything could happen in an election year, So who knows exactly? But I don't anticipate there being a slowdown in October, November as there is every election year. But I don't anticipate there being any major changes in how the economy is functioning or how the economy is going. I know they're going to want to prop it up at least until November.
If there's a big rate cut, so I also saw an article, and I don't know who wrote it as far as the validity. It was in the Wall Street Journal, and they were talking about the only time that the Fed has really blatantly interfered with the election and deviated from what economists suggest they do and what the president wanted. And that was, bringing down rates prior to, or I don't know if it was easing or exactly what they did, but that was the only time documented wise, the statistics bore out that the Fed was influenced by the election. But
when was that? Bringing down rates? You mean the last inflection or the 72?
It was when Nixon was running.
Got it.
Yeah, 72.
Okay. Sorry.
But we'll see. And I don't think we're going to have a major catastrophe. But unless the recession signs, if they pick up, then I think we'll see that easing that everybody's expecting to come sooner than later.
I would agree with that. I would agree with your assessment there. And for whatever reason, I don't have Wi-Fi on my home, so on my phone. So it's telling me that I have a poor connection in Clubhouse. So sorry about that if it's spotty over there for you guys. Elizabeth Nightingale said, I thought 1972, the rate skyrocketed overnight. I need to go back and look at the hot tub time machine. Yeah, I can't remember 1972 because I wasn't alive. But yeah, I feel like it's more balanced this year, which I think is a good thing. It's just a good thing in general for home buyers and sellers. I don't really care about the politics of it. It's just, it's better if you have less volatility, more predictability. I think that's going to lead to more home sales in general because people are going to feel more comfortable. Home builders certainly think it's going to be good. Home builder sentiment improved in January, jumping 7 points to 44 on the National Association of Home Builders Monthly Index. Anything below 50 is still considered negative, but the index has moved 10 points higher in the last 2 months. Alicia Huey, NAHB chairman, said that the lower interest rates improved housing affordability conditions this past month, bringing buyers back into the market after being sidelined in the fall by higher borrowing costs, is what is leading to the increase. Of the index's 3 components, current sales conditions increased 7 points to 48. Sales expectations in the next 6 months jumped 12 points to 57. And buyer traffic rose 5 points to 29. So they have seen a huge decrease in buyer traffic ever since the rates hit the 7%, I believe it was. They've reported slower buyer traffic. But now I feel like because they're some of the only options on the market, it could be a really good time for home builders that can quickly take advantage of it. But I don't think it's going to last, 5 years. I think they're looking at like a year and a half, a 2-year really hot market for builders. Dusty Martin says, stop saying nothing crazy will happen. That's exactly what makes it happen. We had a crazy amount of snow here this last week, and we're technically still snowed in. I can get out because I got a Jeep, but most people aren't moving around. And we had I live on a great hill. And y'all might remember 2 years ago, I think I posted this and we talked about it, but we had an amazing snow, and for days and days, I think it was like a week and a half, we were sledding down. It was a big snow. We had a lot of snow that year. We didn't get that much this time, but I haven't bought a new sled yet. And so we're just using like makeshift stuff and whatever the neighbors have, because there's some neighbors with those old classic sleds. It's really fast. And I know as soon as I buy a sled, then it's going to be like a unseasonably warm winter hits Arkansas, and it's going to be like that until we move. So I haven't bought the sled. But yeah, stop saying nothing crazy will happen, because that's exactly what makes it happen. That's how I feel about buying the sled. That's also why I didn't watch the first half of the Razorback basketball game yesterday. I saw that they were up, and I'm like, I'm not even going to turn it on. I'm just going to wait. And sure enough, as soon as I started watching it, we almost lost. A&M was catching up. Elizabeth says by March 1st, 1972, the Fed had pushed the funds rate down from 5.6 to 3.2. The funds rate rose only slightly to 5% by the time of the election, but it was doubled to 10.4. What? Shortly thereafter? Your comment cut off. Yeah. I would think that would be meddling. NAHB, they also reported, I just wanted to share this. It's not like enough to do a full write-up on, because the data is not enough, but the building materials price growth plummets in 2023. So we had been looking at, if you remember, the lumber per linear foot got up to like $1,600 or something ludicrous, when previously it was kind of hovering from $300 to $400, and it's gone way back down now. So according to the latest producer price index report, growth in the average level of inputs to residential construction, less energy, building materials, fell 15% in 2022 to 1.3% in 2023. Fell from 15% in 2022 to 1.3% in 2023. So growth has plummeted. Softwood, let's see. I mean, they just have that. You could go to NAHB and see the specific data if you're wondering, or if you're a builder and you're wondering what stuff is doing now. But there wasn't a huge write-up on it. It was just basically that sentence. But I guess that also has to put home builders in a better mood if they can get materials for a more reasonable price. Maybe we'll start to see people building fences again. Drop in the chat. Are builders in your area building fences? Because our builders stopped building fences for a long time, and only a few of them have started to rebuild fences. But they were all like, nope, we're not building a fence. Here's your fence contractor. Call him and set it up. We'll give you a slightly lower price on the home. Not putting a fence. So that was an odd thing that happened because of all that in our market. Fences are a paid option in Canada. Has it always been that way, or is that new? For a while, Elizabeth says, for a while, aluminum fences were a better price. That's true. I actually put a steel beam in our home instead of a wood beam because it was cheaper. Olivier said it's been like that for a while, like gutters. Yeah, there's some homes are like that in our area, but usually the high-end stuff, they get fences and gutters and all that. And high-end, by the way, in Arkansas, it's like $500,000 and up. That's like really nice. You could buy a castle here for $1 million. In AZ, fences are standard. A few communities don't have them, and it's usually a block wall. Elizabeth said wood gutters would be a bad idea. Yeah, it's true. So Dusty, fences are standard, like wood privacy fences. They're standard in your area. But what about during the pandemic when wood prices were $1,600 per linear board foot? Was it still standard? Just curious. Okay. So a little participation. I want you guys to drop in the chat. And I'm sorry, Clubhouse, I can't really reference that chat. There's several chats I can reference and several chats I can look at, but I can't really reference that chat. But what are the best markets for first-time home buyers in 2024? Drop in the chat what you think the best markets for first-time home buyers in 2024. Is your city on the list of the best markets for first-time home buyers in 2024? There was a article produced by Realtor.com. You remember we used to own that, the association. There's a different website on there now, but they produced an article that says they used in their 2024 housing forecast, and includes insights to expected home sales growth in the nation's largest 100 metros. We ranked towns and cities according to a list of guiding criteria that could be attractive to first-time home buyers. We ranked 2,738 cities and places with a population of more than 5,000. I'm giving you hints as we go on how they did this. They're located within the 100 largest metros. The rankings were based on the following criteria: the share of 25 to 34-year-old homeowner households among all households, the availability of homes for sale, measured as active listings per 1,000 existing households in the past 12 months, a measure of affordability estimated by the ratio of listing prices and gross household incomes for 25 to 34-year-olds in the city in the past 12 months, the measure of job opportunities, estimated forecast unemployment rate of the city surrounding metro, the average commute time to work, measure of culture. That's liveliness of an area estimated by the count of restaurants, cafes, bars, shopping establishments, other lifestyle businesses, theaters, comedy clubs, art classes listed on Yelp, and forecasted metro sales in the home price growth of 2024, as new buyers may want to ensure to locate to a healthy market which will support equity growth. So I think that's actually all fair. Those seem to be fair. So what cities are on there? What do you think? Olivier says Canada. Is Canada a city? I always get in trouble with the province thing in Canada. So don't start telling me that that's the... Olivier said with the exchange rate would be a great buy for Americans. Elizabeth said, my city is not a good option for first-time home buyers, but towns inland from the coast, approximately 30 miles, are a good option. I'm in Charleston, South Carolina. Okay, Elizabeth, what town is inland do you think would be the best buy for first-time home buyers out there? She says Summerville, South Carolina. She thinks that's the best buy. All right, let's see what Realtor.com says. You'll start at number 10? We should start at number 10. Number 10, Riviera Beach, Maryland. Riviera Beach, Maryland. They have, what's the most astounding stat? Let's do an average 12-month ending November median list price, $264,000. So you could be in Riviera Beach, Maryland, $264,000. The lifestyle number is 16%. Or 16. We'll just call it 16. 16.7 lifestyle score. Okay. Number 9. Feel free to drop your guesses. There may be prizes. Number 9. I've never heard of this city. Mattydale, New York. Who's near Mattydale? Mattydale, New York. Wow, really? The price of a home there is $138,450. Whoa. Mattydale, New York, $138,450. It's a 9.2 on the lifestyle score, though. So it's one of the lowest lifestyle scores, but it looks to be one of the lowest home prices, too. Moore, Oklahoma, Moore. I've actually been through there. It's $231,000. It's a 14 on the lifestyle score. Grand Rapids, Michigan, $260,000 median list price. And they have a 20 on the lifestyle score. Cheektowaga, 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 New York. $199,000 home price. So there's 2 cities in New York on this list, which you can get a home under $200,000. 22.6 on the lifestyle score. That is the highest lifestyle score. Council Bluffs, Indiana. There are 200,000, a 13 on the lifestyle score. Newington, Connecticut. Newington. Newington, Connecticut is a $290,000 list price and a 19.2 on the lifestyle score. Winterset, Indiana. So there's 2 Indianas also on here. $269,400. That's an 18 on the lifestyle score. And look at that. Benton, Arkansas. $197,500 average and a 17.9 on the lifestyle score. And then Irondequoit, Irondequoit. How is that, Olivier, for French? Irondequoit, New York. So there's another New York town. $187,000. It takes the top spot with 14.9 on the lifestyle score. So some of the other things they could say, I just kind of focus on the lifestyle score because I thought that was most interesting, but there's some other things they focused to rank that one at the top, including the 12-month ending November inventory. That was at 34.1. So per 1,000 homes or per 1,000 households, there were 34.1 listings. Goodness, sorry. Olivier said, let's do a full French now. No, I still don't. I can hear French and understand a little bit of it now because I'm like 300 days in, but I still can't think of what to say yet. Maybe I'll get there. Dusty says, yeah, what are taxes? Let me go back and that's a good question. Did they take into account tax base? I don't think that's on the list of their considerations. That is a really great question. Good thought, Dusty. I can tell you from Benton, Arkansas, that is a good low-priced area outside of our metro. So it's about 30 minutes, maybe with traffic outside of Little Rock. So a lot of people live there and work in Little Rock. It is a growing town. It's also close to vacation-y areas like Hot Springs. So you're about 30, 45 minutes away from that. It does have a ton of restaurants. But that's because a lot of people like to eat out. But I think that's a pretty affordable place. I just think we have like 6 or 7 cities that are almost identical to that right around it. So I'm wondering how those rank versus this one. And what was it that kicked those others off? Was it the fewer inventory per household? Because Benton is at 50. Maybe that was what was lackluster because all the restaurants and culture and all that kind of stuff is the same across the board of these little cities that are around our major metro. Some are just bedroom communities though. So maybe there wasn't a lot of job opportunities in that specific city, but in the metro there is. So it's interesting. Benton, Arkansas made the list. How about that? Walmart headquarters, you're close. That's in Bentonville. That's actually 3.5 hours away. So Bentonville is the headquarters of Walmart Northwest Arkansas is also the headquarters of J.B. Hunt, Tyson Foods. We actually have quite a few Fortune 500 companies in Arkansas. Little Rock has some big ones too from, I don't know if you guys are familiar with Dillard's, but it's a big, maybe a regional shopping place. We also have Axiom, the data company, is here. Stevens Financial Company is here. So there's some big companies here in Little Rock as well. But our number one employer, because Little Rock is the capital city, is government. Number two is healthcare. So, I mean, with all the restaurants we have in the area, both of those are going to stick around. Irondequoit is a suburb of Rochester on the lake, says Eric. Ooh, it's on the lake? That's nice. All right. That's all I have for today. Yay! Thank you guys for joining the show. Drop in the comments what you think is the most affordable city. Let me know you're watching the replay. And please connect with me on Instagram. That's probably the best way. Razorback, RAYZORBACK. And don't forget to do all the subscribey things. Hit the bell so that you can be alerted of whenever we go live so that you can join the live show. And if you want to join the contributor chat, send me a message on Instagram letting me know, and I will add you to our contributor chat, which is a Facebook messaging group. And we basically just talk about articles, stuff that's going on. I'll post in there before the show, like, hey, here's what we're thinking about covering today. And you can add to it, suggest something. So Dusty suggested that article from Arizona this week, so it's from them. But thank you guys for joining us, and I'll see you next week.